So what is HKEX? It's the well-known HKEX. Its full name is the Hong Kong Exchanges and Clearing Limited, and it is a listed company. So it's called HKEX. Is it an exchange? No, it's not. As we mentioned in Chapter 1, HKEX controls various exchanges and clearinghouses in Hong Kong, so it is known as an exchange controller, okay? So which exchanges does HKEX control? 1. The SEHK, the Stock Exchange of Hong Kong Limited, responsible for securities trading. 2. The HKFE, the Hong Kong Futures Exchange, responsible for futures trading. And which clearinghouses does HKEX control? 1. HKSCC, the Hong Kong Securities Clearing Company Limited, responsible for securities settlement of the SEHK. 2. HKCC, the HKFE Clearing Corporation Limited, responsible for futures settlement of the HKFE. 3. SEHK, the SEHK Options Clearinghouse Limited, responsible for options settlement of the SEHK. 4. OTC Clear, the OTC Clearing Hong Kong Limited, responsible for OTC, over-the-counter derivatives clearing. What does the HKEX, Hong Kong Exchanges and Clearing Limited regulate? Remember, HKEX is the boss. It is the controller of various exchanges and clearing houses. As the boss, it naturally has to regulate the transactions, settlements, and deliveries conducted by the exchanges. In addition, HKEX has to enforce the listing rules. In simple terms, it has to regulate the listed companies and the securities issued by the listed companies. HKEX will determine according to the listing rules what requirements securities must meet in order to be listed on the SEHK, the Stock Exchange of Hong Kong Limited, and what responsibilities the issuer must fulfill, etc. Here's a shocking secret: HKEX is actually a listed company itself. It is listed on the SEHK with the stock code 0388.HK. So, remember, HKEX is just a holding company. It doesn't do trading, nor does it do clearing. As the boss, the most important thing is to keep an eye on the smaller ones. Don't let them mess around. Daily trading, clearing, these are left to the smaller ones to do. So you might think, HKEX regulates listed companies, regulates transactions conducted on the exchange and related clearing and settlements. What does the SFC, Securities and Futures Commission, regulate? The SFC is responsible for regulating intermediaries who conduct transactions on the exchange and the relationships between intermediaries and between intermediaries and clients. The two bosses, each doing their own job, should not be mixed up. Alright, so what's the difference between an exchange and a clearinghouse? Well, remember, an exchange is just for trading, that is, handling transactions between buyers and sellers. How do they handle it? They collect trading instructions from buyers and sellers, and then through the matching system, they match the buying and selling instructions together to form a transaction. They only do this. In fact, the exchange is like a matchmaker, looking at what single men and women there are, what spouse requirements there are. If the match is right, they match this pair of men and women together and arrange a date for them. As for whether these two people end up together in the end, it's none of their business. After the transaction is formed, what should be done next? The buyer has to pay, the seller has to deliver. One hand pays the money and the other hand delivers the goods to complete the transaction. This is called clearing. Remember, clearing is not the responsibility of the exchange, it is handled by the clearinghouse. So what if the buyer can't pay, or the seller can't deliver? The collection of payments or goods is also done by the clearinghouse. That is to say, the buyer or seller doesn't have to go after the debtor themselves, they can just hand it over to the clearinghouse. To put it bluntly, the clearinghouse here is the collector, helping you get back the debt, alright? Hong Kong currently has two exchanges, both of which are subsidiaries of the HKEX, Hong Kong Exchanges and Clearing Limited. One is called SEHK, the Stock Exchange of Hong Kong Limited, which provides a venue for investors to trade securities. So, what securities can be bought and sold here? It includes stocks, bonds, subscription warrants, exchange-traded products, and structured products such as derivative warrants and bull-bear contracts, all of which are traded on the SEHK. As for the system that the SEHK uses to match trades, it is called the OTPC, the Orion Trading Platform. The other one is HKFE, the Hong Kong Futures Exchange, which provides a platform for trading futures contracts. Do you still remember what futures contracts are? That is, the buyer and seller agree to trade a specific commodity or asset at a specific price at a future time, which is a type of financial derivative. As the name suggests, futures contracts are traded on the HKFE. The electronic trading system it uses is called CCASS, the Hong Kong Futures Automated Trading System. After a trade is made, who does the clearing and settlement? The clearinghouse. Do you remember how many clearinghouses there are in Hong Kong? There are currently 4 clearinghouses. Next, let's talk about HKSCC, the Hong Kong Securities Clearing Company Limited. Remember, it is the venue for clearing and settlement of securities trades on the SEHK, and the clearing and settlement system it uses is called CAS, the Central Clearing and Settlement System. The second one is HKCC, the HKFE Clearing Corporation Limited, which is responsible for the clearing and settlement of futures and options traded on the HKFE. So, what system does it use? It uses CAS, the Derivatives Clearing and Settlement System. The third one is SEHK, the SEHK Options Clearinghouse Limited, which is responsible for the clearing and settlement of stock options on the SEHK, the Stock Exchange of Hong Kong Limited. Do you find it strange? Why are stock options called stock exchanges stock options? Be careful in the exam, these stock options are really tricky. Stock options in Hong Kong are a monster. Why are they called a monster? Look at the table on the right. Where is its trading venue? It's the SEHK. So even though it's an option, the trading venue is the SEHK, so it's called the stock exchange's stock options. However, the trading system it uses is CATS, the Hong Kong Futures Automated Trading System. Remember, it's not OPTC, the Orion Trading Platform. The trading system used by stock options is the same electronic trading system CATS as futures trading. That is to say, stock options are on the SEHK, using the futures trading system for trading, so isn't it strange? Although stock options use the electronic trading system CATS for trading, the settlement is neither HKCC, the HKFE Clearing Corporation Limited, nor HKSCC, the Hong Kong Securities Clearing Company Limited. Since it is a monster, it needs a special person to deal with it. Who is this person? It is SEHK, the SEHK Options Clearinghouse Limited. However, the clearing and settlement system it uses is also CAS, the Derivatives Clearing and Settlement System. In addition to this, there is another clearinghouse called OTC Clear, the OTC Clearing Hong Kong Limited. This clearinghouse does not serve the exchanges under the HKEX, Hong Kong Exchanges and Clearing Limited, that is, it does not provide clearing and settlement services for the SEHK, the Stock Exchange of Hong Kong Limited, or the HKFE, the Hong Kong Futures Exchange. It mainly handles the clearing services of OTCD, over-the-counter derivative transactions, that is, the settlement of financial products not traded on the HKEX. As we mentioned in Chapter 4, in order to implement central clearing of OTCD, the SFC, Securities and Futures Commission introduced the subsidiary legislation. OTCD Clearing Rules. Designated OTCD transactions need to fulfill mandatory clearing obligations, so who is their central counterparty? It's the OTC Clear. It is the central counterparty designated by the SFC. So remember, the OTC Clear does not provide trading, does not do trading. It only does clearing, that is, chasing the buyer to pay and the seller to deliver, okay? The OTC Clear started operations in 2013, and its founding shareholders were the HKEX and a consortium of 12 financial institutions. So, the OTC Clear is also a subsidiary of the HKEX, but it is not wholly owned by the HKEX. The HKEX holds a 76% stake, which is also different from other clearinghouses. Have you started to feel overwhelmed since you got here? These exchanges, clearinghouses, each providing different products and using different electronic systems, it's really confusing. Don't worry, 2C Exam is here to help. We have compiled a summary table to facilitate your revision. Now, let's look at this table together and start trying to memorize it. First category, securities. Where to trade? Trade securities on the SEHK, the Stock Exchange of Hong Kong Limited. What system to use? OTC, the Orion Trading Platform. Where to clear and settle? HKSCC, the Hong Kong Securities Clearing Company Limited. What system to use? CCASS, the Central Clearing and Settlement System. Second category, futures. Where to trade? Trade futures on the HKFE, the Hong Kong Futures Exchange. What system to use? CCASS, the Hong Kong Futures Automated Trading System. Where to clear and settle? HKCC, the HKFE Clearing Corporation Limited. What system to use? CCASS, the Derivatives Clearing and Settlement System. Third category, stock options. What is it? Monster. Where does the Monster trade? Trade on the SEHK. What system to use? CCASS. Where to clear and settle? The Monster needs a specialist to deal with it, which is SEHK, the SEHK Options Clearinghouse Limited. What system to use? CCASS. Fourth category, OTC, over-the-counter derivatives. Where to trade? Over-the-counter. That is, outside the exchange. Is the OTC completely unregulated? No, some OTC derivative trades need to be mandatorily cleared. So where to clear? OTC Clear, the OTC Clearing Hong Kong Limited. Does the OTC Clearing Company trade? No. There are some ways to help you remember this content. If the trading system uses OTC, then the clearing and settlement system must be CCASS. If the trading system uses CCASS, then the clearing and settlement system must be CCASS. With so many names, I can't remember which is the trading system and which is the clearing and settlement system. What to do? Do you know what S means? Whenever you see S, it's so crude that it must be for clearing and settlement. I wonder if you all remember, when we watch TV, there are always a lot of people running around at the SEHK, the Stock Exchange of Hong Kong Limited. I want to ask you all, do you think that after becoming a licensed corporation and a registered institution, you automatically have the right to trade on the SEHK or HKFE, the Hong Kong Futures Exchange? Remember, definitely not. Only a small number of intermediaries have the right to be exchange participants. Most intermediaries are not exchange participants, okay? However, if you want to become an exchange participant, you must be an intermediary. That is, an intermediary does not necessarily have to be an exchange participant, but an exchange participant must be an intermediary. For example, DBS Bank in Hong Kong is a registered institution. But it is not an exchange participant, which means it does not have the qualifications to be a participant in the SEHK or HKFE, okay? So remember, in this situation, since DBS is not an exchange participant, if a client requests to buy and sell Hong Kong stocks, DBS Bank can only commission other exchange participants, such as DBS Vickers, to carry out the stock trading for the client, okay? How can one become an exchange participant? First, you need to be an intermediary, that is, a licensed corporation or a registered institution. In other words, you need to be licensed by the SFC, Securities and Futures Commission, to engage in Type 1 or Type 2 regulated activities. Second, you need to have at least one trading right, which is the right to trade on the exchange. Are these trading rights free? Of course not. Each trading right costs 500,000 Hong Kong dollars. Remember, trading rights cannot be transferred. Third, you need to register with the exchange to become an exchange participant. After registration, you have to pay a fee and a deposit. Do you understand? After you have completed the trade, if you want to settle, you also need to become a participant of the clearinghouse. Similarly, you have to pay a fee and a deposit to the clearinghouse. Note: participants of the clearinghouse must be participants of the exchange, but participants of the exchange are not necessarily participants of the clearinghouse. This is because futures trading does not necessarily require settlement. We will talk about this issue later. Don't think that there is nothing to do after becoming a participant. After becoming an exchange participant, you need to submit a form of attestation to the HKEX, Hong Kong Exchanges and Clearing Limited, every year to assess whether you have complied with the relevant regulations. Next, let's talk about Stock Connects. The Shanghai Connect, Shanghai Hong Kong Stock Connect, and Shenzhen Connect, Shenzhen Hong Kong Stock Connect, together known as the Stock Connects, are actually linking the stock markets of Shanghai, Shenzhen, and Hong Kong. The so-called northbound trading links allows investors in Hong Kong to buy eligible securities on the Shanghai and Shenzhen stock markets, i.e., certain A shares and funds, but not including B shares and other listed securities such as bonds. At the same time, it allows investors from mainland China to buy eligible securities listed on the SEHK, the Stock Exchange of Hong Kong Limited, i.e., designated Hong Kong stocks and funds, which is called the southbound trading links. The Mutual Market Access Scheme has a daily trading quota. What does that mean? Simply put, it only allows all mainland Chinese investors to buy a certain amount of Hong Kong securities each day. Each day, all the Hong Kong securities bought by mainland investors are accumulated and can only buy a certain quota. Conversely, for Hong Kong investors buying A shares, the daily trading volume of A shares bought by all Hong Kong investors cannot exceed the set quota. Do you understand? So how much do you think the daily trading quota is now? The answer is, the current northbound trading daily quota is 52 billion renminbi, and the southbound trading daily quota is 42 billion renminbi. So how is this daily quota calculated? The daily quota is calculated based on the net buy volume, which means the quantity bought each day minus the quantity sold. This difference is the net buy volume. For example, if you buy 1 million shares in a day, but sell 300,000 shares, then the net buy volume is 700,000 shares. Then this difference is used to calculate the daily quota. You may have noticed that only the buy orders have this daily quota restriction. The sell orders are unlimited. Therefore, the sell orders actually increase the available balance of the buy orders. Another point you need to remember is that you need to comply with local laws when trading. For example, Hong Kong investors buying A shares need to comply with mainland China securities laws. If mainland investors buy stocks on the SEHK, the Stock Exchange of Hong Kong Limited, they need to comply with Hong Kong laws, alright? Here we can see two directions. 1. Northbound. Northbound refers to Hong Kong investors buying mainland A shares. Who can buy mainland A shares through the Stock Connects? Is it only for Hong Kong people? No, anyone with a securities account in Hong Kong can buy mainland A shares. However, please note that if the investor holds mainland documents, opens a personal or joint account, and mainland registered organizations, whether they are legal persons or non-legal persons, cannot buy mainland A shares through the Stock Connect. How to buy and sell? Investors can trade through intermediaries who have registered as SEHK exchange participants. Participants of the Stock Connect registered with the SEHK, the Stock Exchange of Hong Kong Limited, are called China Connect exchange participants, SEPs, and only those who have registered as CCEP can execute trading orders. The HKSCC clearing participants that register to participate are known as China Connect clearing participants, CCCPs, and the HKSCC, the Hong Kong Securities Clearing Company Limited, mainly bears the settlement responsibility of CCCP. Can all A shares be bought? Not all are available. Only eligible securities, i.e. designated A shares or funds, can be bought and sold. Where to trade? Trade on the SSE, Shanghai Stock Exchange through the Shanghai Connect, Shanghai Hong Kong Stock Connect, or on the SZSE, Shenzhen Stock Exchange through the Shenzhen Connect, Shenzhen Hong Kong Stock Connect. Which exchange rules to comply with when trading on the SSE and SZSE? The rules of the SSE or SZSE. Which local laws to comply with? The laws of mainland China. What is the name of the clearinghouse? For trading on the SSE/SZSE, it will be the China Securities Depository and Clearing Corporation Limited, referred to as China Clear, for clearing and settlement. When are the securities settled? T+0. When is the payment settled? T+0 or T+1. 2. Southbound, i.e. mainland investors buying Hong Kong stocks. If mainland investors want to buy Hong Kong stocks, who can use the Stock Connect to buy Hong Kong stocks? Note: only institutional investors and individuals who hold at least 500,000 renminbi in assets in their securities and funds accounts can buy Hong Kong stocks through the Stock Connect. Don't get it wrong, not everyone can play. What securities can be bought and sold? The same, only eligible securities, i.e. listed shares and funds, can be bought and sold. Where to trade Hong Kong stocks? Trade on the SEHK of Hong Kong through the Stock Connect. Which exchange rules to comply with? The rules of the SEHK. Which country or region's laws to comply with? Hong Kong laws. Which clearinghouse to use? What's the name? As I mentioned before, it is the HKSCC. When are the securities settled? It's T+2. When is the payment settled? It's also T+2. Northbound trading refers to Hong Kong investors buying mainland securities. Do you still remember what securities can be bought and sold? The first type is eligible A shares, but not all A shares can be traded northbound. Only eligible A shares are allowed. So what kind of A shares are considered eligible A shares? And what are the requirements? Let's have a general understanding. Let's talk about the A share index. In the past 6 months, 4 indicators need to be met to be considered eligible. First, it must have a daily average market capitalization of at least 5 billion renminbi in the last 6 months, which means the company must have a certain scale. Second, it must have a daily average turnover of at least 30 million renminbi in the last 6 months. There must be sufficient trading activity. Third, it must not have been suspended for trading on any SSE market on 50% or more of the trading days in the last 6 months. Fourth, if it is also a stock with differentiated voting rights, it must also fulfill additional criteria. In addition, there is a special type of A shares. They are A shares listed in China and also have H shares listed on the SEHK, the Stock Exchange of Hong Kong Limited. These are also eligible A shares that can be traded northbound. The second type of securities that can be traded northbound is eligible funds. So what conditions need to be met to become an eligible fund? Let's introduce it so you have a general impression. Firstly, this fund has been listed for at least 6 months, and the benchmark index it tracks has been launched for at least 1 year. In other words, the fund needs to have been operating in the market for a while and needs to have stability. In addition, the average AUM, assets under management of this fund in the past 6 months, cannot be less than 1.5 billion renminbi, proving that it has a certain scale. The benchmark index that this fund tracks also needs to comply with other regulations, such as total weighting and methodology used, etc. Southbound trading refers to mainland investors buying Hong Kong stocks. Can all Hong Kong stocks be bought? No, only eligible stocks. So which ones are eligible stocks? These are the index constituents that you often hear about in financial news. That is, constituent stocks of the Hang Seng Composite Large Cap Index, constituent stocks of the Hang Seng Composite Mid Cap Index, constituent stock of the Hang Seng Composite Small Cap Index with a market capitalization of 5 billion Hong Kong dollars or above. There is also a type of H shares, which are not in these index constituent stocks, but have corresponding shares in the form of a shares listed on SSE, Shanghai Stock Exchange, or SZSE, Shenzhen Stock Exchange. These are also considered eligible stocks. So what are ineligible stocks? Hong Kong stocks that are not traded in Hong Kong dollars. In addition, H shares that are listed and traded on a mainland China exchange other than the SSE or SZSE, or A shares that are being implemented with risk alerts by the SSE or SZSE, or H shares with delisting arrangements. These are all ineligible stocks and cannot be traded in southbound trading. The second category of securities that can participate in southbound trading is eligible funds. What are the conditions that need to be met to become an eligible fund? Firstly, the fund must be regulated by the SFC, Securities and Futures Commission. Can unregulated funds participate in southbound trading? No, they cannot. Similarly, the fund must have been listed for at least 6 months, and the benchmark index it tracks must be launched for at least 1 year. This requirement ensures that the fund has market operation experience and stability. Additionally, the fund must trade in Hong Kong dollars, and its daily average AUM, assets under management in the past 6 months, must be no less than 1.7 billion Hong Kong dollars. In other words, the fund must have a certain level of market size. Northbound trading has pre-trade checking, one of which is called standard pre-trade check. So what exactly is it? The SSE, Shanghai Stock Exchange / SZSE, Shenzhen Stock Exchange, does not allow day trading, which means a type of securities trading behavior that involves buying and selling on the same trading day. Therefore, investors are not allowed to sell before the completion or settlement of the stocks they bought. So you might ask, how should investors sell securities through the northbound trading link? If investors want to sell securities through the northbound trading link, Hong Kong and overseas investors must deposit the securities they plan to sell into a designated broker account, i.e., an account opened by the designated HKSCC, the Hong Kong Securities Clearing Company Limited in China Clear, on the day before the trade, i.e., T1 day. The SSE and the SZSE will check on each trading day, i.e., T day, and if there are not enough stocks in the investor's account, they will reject the related sell orders. This is the standard pre-trade check. In addition to standard pre-trade checking, investors can also opt for another method: enhanced pre-trade check. So how does enhanced pre-trade check work? And what's the difference from the previous method? If investors choose to keep their securities with a custodian or with a general clearing participant of the HKSCC, the Hong Kong Securities Clearing Company Limited, these securities will also be kept in a comprehensive account opened by the HKSCC in China Clear. However, investors need to open a special segregated account, SPSA, in the CASS, the Central Clearing and Settlement System, so that the shareholding records of the SPSA can be directly copied to the pre-trade checking system. Investors can then transfer the shares to the designated broker's account after executing and matching the sell orders. This type of monitoring is called enhanced pre-trade check. So let me ask you again, what's the difference between the two pre-trade checking methods in northbound trading? Standard pre-trade check requires investors to deposit securities into a designated broker account before making a sell order, i.e., on T1 day. Enhanced pre-trade check is like an upgraded version of the former. Does upgrade mean some improvements? Investors can transfer the securities to the designated broker account after executing the sell order. To combat market misconduct and strengthen cross-border regulatory cooperation, the northbound trading has also introduced the investor identification regime. Does it sound familiar to everyone? We talked about the Hong Kong investor identification regime in Chapter 5, and the operation is quite similar. CCEP, China Connect Exchange participant must assign a unique BCAN, broker-to-client assigned number to each northbound trading client. So how is the whole process done? First of all, the BCAN needs to match the client identification information. So what's the first step for CCEP? It's to get the client's information. Wait a minute. Before getting the client's information, there is a very important thing to do. Can you guess what it is? It's to get the client's written consent. So what other information needs to be obtained? Client's name, identification documents, etc. If CCEP wants to input northbound buy and sell orders on the trading day, T-day, it needs to send a mapping information file to the SEHK, the Stock Exchange of Hong Kong Limited, on T1 day or earlier for verification by the SEHK. In future transactions, CCEP must provide the corresponding BCAN for each trading order. What happens in the event of a default? How would the HKSCC, the Hong Kong Securities Clearing Company Limited, handle it? If a CCEP, China Connect Exchange participant, defaults in northbound trading, i.e., the CCCP fails to fulfill its trading obligations either by failing to pay or deliver, what happens? The HKSCC would declare, "This CCCP is a defaulter," and then it would liquidate its positions, whether they are Hong Kong shares or the SSE, Shanghai Stock Exchange / SZSE, Shenzhen Stock Exchange securities. If there is still a loss after liquidation, it will be covered by the collateral. If the collateral is insufficient to cover the loss, the guarantee fund would be used. On the flip side, if China Clear defaults in southbound trading, how would the HKSCC respond? In the event of a southbound trading default, the HKSCC would pursue the recovery of stocks and monies through legal means, and then distribute the recovered stocks and monies to the CCCP on a pro rata basis. There are many restrictions in northbound trading. The laws of the two places are like Peking duck and Cantonese roast goose, both are delicacies, but the taste and cooking methods may be different. So when we do northbound trading, we have to comply with the rules and laws of the mainland exchanges. Now let's talk about margin trading. Who can provide margin trading? Only two types of people are permitted. First, CCEP, China Connect Exchange participants. Second, exchange participants who can trade for clients through CCEP. In northbound trading, can all securities be used for margin trading? The answer is no. Only specific securities of the SSE, Shanghai Stock Exchange / SZSE, Shenzhen Stock Exchange can. So let's talk about which securities are eligible and which are not. The first type is eligible shares, which can be used for margin trading. But are there no restrictions at all? No. Margin trading is very risky. Therefore, when the margin trading indicator of eligible shares reaches 25%, margin trading must be suspended. But don't worry, as long as it falls back below 20%, margin trading can be resumed. The second type is eligible ETFs, exchange-traded funds, which can also be used for margin trading. Like shares, there are restrictions to control risk. What is the restriction? If the balance of margin trading, i.e. the value of the funds or securities provided, or the market value of the collaterals in the margin account, reaches 75% of the ETF's listed and tradable market capitalization, margin trading will be suspended. Only when it falls back to 70% or below can margin trading be resumed. Under what circumstances can SBL, securities borrowing and lending, be conducted in northbound trading? In northbound trading, investors borrow northbound trading link eligible securities and then sell them on the SSE, Shanghai Stock Exchange / SZSE, Shenzhen Stock Exchange. Note that even if there is borrowing and returning, securities lending can only be permitted under the following two circumstances. If the purpose is to conduct covered short selling activities, no problem, SBL can be conducted. In this case, the validity period of the SBL cannot exceed 1 calendar month. If the purpose is to comply with the requirements of pre-trade checking, i.e., transferring a sufficient quantity of eligible securities to the sell-side broker before trading, it is also no problem. However, the validity period of the SBL cannot exceed 1 day, and it cannot be renewed. So you might ask, if I hold a lot of securities, can I lend them out on the SSE, Shanghai Stock Exchange / SZSE, Shenzhen Stock Exchange anytime I want? The answer is no. You can't just lend them out whenever you want. Only those designated by the SSE / SZSE are eligible to lend out shares. Moreover, all SBL securities lending and borrowing activities must be reported to the SEHK, the Stock Exchange of Hong Kong Limited. You can't do these activities secretly. There are additional regulations for northbound trading. What do they include? Firstly, there are some restrictions on foreign investment. If you are a foreign investor and want to invest in a listed company in mainland China, your shareholding cannot exceed 10% of the shares issued by the company. In other words, you can invest in the company you are interested in, but you cannot be greedy and cannot hold more than 10% of the shares. In addition, the total shareholding of all foreign investors in a listed company in mainland China cannot exceed 30% of the shares issued by the company. If the shareholding ratio of foreign investors is close to these limits, the SSE, Shanghai Stock Exchange / SZSE, Shenzhen Stock Exchange will notify the HKEX, Hong Kong Exchanges and Clearing Limited, and then the HKEX will announce this news on their website. It's like a gentle reminder, reminding these foreign investors to pay attention to their shareholding ratio. Once the 30% limit is exceeded, these foreign investors will be required to sell some of their shares. In addition to foreign investment, if anyone holds 5% of the shares of a company in mainland China, they must proactively make a disclosure. Let me ask you a question. Can we actually conduct short selling through northbound trading? Northbound trading doesn't allow casual short selling. If you want to engage in short selling, uncovered short selling is not permitted, only covered short selling is allowed. But remember, you can only short sell eligible securities, you cannot short sell ETFs, exchange-traded funds. Additionally, there are limitations on the quantity and price for short selling. When the total open short position of a certain A-share reaches 25% of the stock's listed and tradable shares, the SSE, Shanghai Stock Exchange / SZSE, Shenzhen Stock Exchange can temporarily suspend short selling of that stock. However, if it falls back below 20%, short selling can be resumed. Doesn't it seem quite complex when you first hear about it? Actually, there's no need to be overly concerned. Just grasp the general idea for now. In the next section, we will provide a more detailed explanation of the concepts of short selling and short positions. What rules should be followed when trading on the SEHK, the Stock Exchange of Hong Kong? Remember, in addition to the frequently mentioned SFO, Securities and Futures Ordinance, there are 4 rules to follow when trading on the SEHK. One is called the Rules of the Exchange. One is called the General Rules of CASS. One is called the Options Trading Rules of the Stock Exchange. One is called the Options Clearing Rules of the SEHK. All right? Do you remember when we introduced the participants of the exchange, we mentioned that licensed corporations or registered institutions cannot directly trade on the SEHK, the Stock Exchange of Hong Kong, or the HKFE, the Hong Kong Futures Exchange, after they are licensed. Only a small number of intermediaries have the right to become exchange participants. Most intermediaries are not participants in trading. Intermediaries can only trade on the exchange after they have obtained trading rights and registered as exchange participants. After all this, you might ask, so what are the conditions for each exchange participant? Let's first introduce the participants of the SEHK. Do you remember what is traded on the SEHK? Stocks, funds, bonds, bull-bear certificates, warrants, stock options, these all belong to Type 1 regulated activities, right? So, what are the specific conditions to become a participant of the SEHK? First, it must be a company, that is, an intermediary with a Type 1 license. Second, it must meet the requirements for capital and liquid capital. Third, and most importantly, it must have an executive director registered as a responsible officer. We have already talked about this in chapters 3 and 4, that intermediaries must have an executive director as a responsible officer, and this requirement is repeated here. What are Hong Kong workers most nervous about on typhoon days? That's right. It's whether they have to go to work on time and whether the market will open on time. So, what time does the SEHK, the Stock Exchange of Hong Kong, open and close? First of all, the trading days of the SEHK are from Monday to Friday. As for what time trading can take place, you can look at the green list on the right. Just like the class schedule when you were studying, a trading day has different trading sessions. Different times will do different things, and we will introduce them to you later. So, what time does the SEHK close? On a normal trading day, the closing time of the securities market is any time between 4:08 p.m. and 4:10 p.m. That is to say, even if you look at the clock, you can't know the exact closing time. What is the pre-opening session? Simply put, it is a period of time before the official start of trading. That is to say, the SEHK, the Stock Exchange of Hong Kong, has opened its doors, but has not yet opened the market. Although stock trading has not officially started during this time, the SEHK allows investors to submit buy and sell orders. Some people may ask, what's the use of this if it's not the official trading time? In fact, this time period not only allows investors to have more time to analyze market conditions and prepare for trading in advance. At the same time, it can also alleviate the pressure of a large number of buy and sell orders, input, and trading instructions that may occur at the start of the morning session. After the pre-opening session is over, it's the CTS, continuous trading session. The CTS is divided into two periods. The morning session, which is from 9 a.m. to 12 p.m. The afternoon session, from 1 p.m. to 4 p.m. During this CTS, the SEHK, the Stock Exchange of Hong Kong, can conduct formal trading, continuously executing and matching buy and sell orders. Moreover, during this period, we will calculate the closing reference price and implement VCM, Volatility Control Mechanism. Don't know what the closing reference price is? How does the VCM work? Don't worry, we will answer these questions for you later. Let's talk about how the closing price is calculated. In the last minute of the CTS, continuous trading session, starting from 15 hours and 59 minutes, the system records the stock's nominal price, i.e., execution price, every 15 seconds. The median of the 5 nominal prices recorded in the last minute becomes the closing price for the CASS closing auction session. Not clear? Let's look at a practical example. Suppose in the last minute, the traded prices of a stock are $80, $81, $82, $83, and $84. Among these 5 prices, we would pick the price in the middle, i.e., the median, which is $82, as the closing price for this stock. So what is the use of closing price? In fact, it is very important for the CAS closing auction session. The so-called CAS usually takes place in the last period of the trading day. During this session, market participants, such as investors, fund managers, etc., can input buy and sell orders within a range of 5% above and below the closing price. These buy and sell orders are then all collected, sorted, and matched. If they cannot be matched, the orders will naturally be canceled. We mentioned that the SEHK, the Stock Exchange of Hong Kong, has a random closing session, right? Its purpose is to prevent market manipulation. After the random closing session ends, a final IEP, indicative equilibrium price, will be determined. All securities traded during the closing auction session will be matched according to the final IEP. Have you ever thought about what we should do if we can't establish the final IEP in the closing auction session and there is no closing price? In that case, we would consider the market reference price as the final IEP to match the buy and sell orders, becoming the final closing price For the security's closing price. If you're still confused and don't quite understand, you can look at this diagram. This diagram is very clear and shows how the CASS closing auction session works. Have you ever thought about what we can buy and sell during the CASS closing auction session? It's not just stocks. There are also equities such as depository receipts, investment companies, and preference shares, funds such as ETFs, exchange-traded funds, and REITs, real estate investment trust, and even LIPs, leveraged and inverse products. Trading at the closing price is a key investment mandate of some funds such as index trackers. Why is that? Well, because the performance of a stock index is based on the closing prices of its constituent stocks. So, the fund is like a speedboat. Its goal is to keep up with its target index as much as possible. If fund managers want their fund to perform as closely as possible to the index they are tracking, they need to ensure that the number of each stock held by the fund matches its weight in the index. For example, suppose the price of a certain stock rises at the end of the trading day, then the weight of the stock in the index will also increase. To make the fund's performance as close as possible, the fund manager may need to adjust during the closing time. Next, let's talk about the VCM, Volatility Control Mechanism. Before we start, I want you to guess, why do we need a market volatility control mechanism? Now, let me tell you two stories. On May 6, 2010, the U.S. stock market experienced a historic flash crash. On that day, the Dow Jones Industrial Average plummeted in a straight line, with a nearly 1,000-point difference between the high and low points. What can you do in 5 minutes? Have a cup of tea? Watch a YouTube video? But in these 5 minutes, the U.S. stock market evaporated $1 trillion. Well-known companies such as General Electric, GE, and Accenture saw their stock prices plummet to $1, and thousands of transactions were subsequently canceled, shocking the global financial market. The tragedy of trading incidents is not just a single case. Let me tell you another story. On August 1, 2012, Knight Capital updated its trading software. As expected, an accident occurred immediately. In less than 45 minutes, the trading system sent millions of trading orders at a high frequency, with an average of over 1,500 transactions per second, and a total trading volume of up to $6.65 billion. What was the result? Due to this programming error, Knight Capital eventually suffered a loss of up to $460 million. After listening to the two stories, you may already have an answer in your mind as to why we need a VCM, volatility control mechanism. It is to mitigate extreme price fluctuations caused by trading accidents, such as flash crashes or algorithm errors, which can lead to a sharp rise or fall in stock prices. Now, I have another question for you all. Do you remember when the VCM applies? The answer is, it only applies during the CTS, continuous trading session. So, is there a market VCM during the CAS, closing auction session? No, there isn't. Which securities does the VCM, volatility control mechanism, apply to? The VCM applies to which securities? In the spot market, it applies to constituent stocks of the Hang Seng Composite Large Cap Index, constituent stocks of the Hang Seng Composite Mid Cap Index, and constituent stocks of the Hang Seng Composite Small Cap Index. As for the futures market, it covers spot and next calendar month index futures contracts with Hang Seng Index, Mini Hang Seng Index, Hang Seng China Enterprises Index, Mini Hang Seng China Enterprises Index, or Hang Seng Tech Index as their underlying index. How does the VCM, volatility control mechanism, adjust market volatility? When the current trading price of any stock or futures contract differs from its last trading price 5 minutes ago by more than the trigger threshold, this financial product will enter a 5-minute cooling-off period. Simply put, if the product price experiences drastic fluctuations, with too high an increase or too low a decrease, it will trigger a cooling-off period. For example, suppose there is a stock now, and its transaction price 5 minutes ago was $100. The trigger threshold for this stock is 10%. If the price rises or falls by more than 10%, becoming $110 or $90, what will happen? It will trigger a 5-minute cooling-off period. After a security enters a cooling-off period, do you think trading can still be conducted? Actually, trading can still be conducted. However, it must be within certain price limits. Using the previous example of the stock, after triggering the 5-minute cooling-off period, the stock can only be traded between $90 and $110. In other words, the stock is not allowed to surge or plummet drastically. After the 5-minute cooling-off period, normal trading can resume. All right? What is direct business? Direct business, also known as cross-trade, is when an intermediary acts as a principal or agent and represents both the buyer and the seller at the same time. For example, there is a securities firm called Kaohsiung Securities. A buyer wants to buy 500 shares of HSBC through Kaohsiung Securities, and at the same time, another client calls Kaohsiung Securities wanting to sell 1,000 shares of HSBC. In this situation, Kaohsiung Securities represents both the buyer and the seller. If the buyer and seller can make a transaction through the same intermediary, it is called direct business or cross-trade. Remember, if you conduct direct business through a computer, it is considered automated trading. The data of this transaction must be entered into the system within 1 minute after the transaction, including the price, quantity, time, etc. of the transaction. If it is manual matching, that is, the broker does not enter the order into the computer, but actively matches the two clients. Within 15 minutes after the transaction data must be entered into the system to let the exchange know that you have made this transaction, okay? Well, be aware that there are definitely costs involved in buying and selling stocks. Yes, you heard right, buying and selling stocks is not free. If there were no costs, how would the financial world make money, right? There are many different types of fees, but only a small part is collected by the intermediary, including what? That is, commissions and commissions for initial public offerings. So do you know what is the minimum commission for buying and selling stocks now? The answer is 0. There is no limit, you can choose not to charge. So what is the minimum commission for initial public offering? The minimum is 1%, okay? So remember, I won't go into detail about this table. Most importantly, you need to look at a few things. First, who collects these fees, and whose pocket does the money ultimately go into? The levy agent is responsible for counting the money. The levying institution is where the money will ultimately go. For example, the stamp duty on stock transactions is collected by the SEC, but it ultimately goes to the government. Second, there are two types of transaction levies. The SFC, Securities and Futures Commission Transaction Levy, is 0.0027%, and the FRC, the Accounting and Financial Reporting Council Transaction Levy, is 0.00015%. Third, the only thing that really goes into the SEX, the Stock Exchange of Hong Kong own pocket, is the transaction fee, which is 0.00565%. Fourth, anything called a tax goes to the government. The stock stamp duty is 0.13%, and the transfer paper stamp duty is 5 Hong Kong dollars. Fifth, the registrar also charges a fee. It's not for free, so it charges you a transfer fee of 2 Hong Kong dollars and 50 cents. Take a look at this table and you will know what fees are involved. So to let you know about commissions, we often see that in the exam, so you have to be careful. Okay? Next, we will specifically introduce short selling. So what is short selling? Remember, short selling is what is commonly referred to as shorting on TV. So what is shorting? Shorting means that you do not currently own shares or stocks, but you have already sold them. Some people might immediately ask,
"Hey, I don't have any stocks. How can I sell them?"
For example, you don't have HSBC stocks right now, but you think the price of HSBC is too high and will fall soon. So, you sell it at $80, and then you can buy it back at $50 later. Selling and buying completes the transaction, and you earn $30. That is, you sell the goods first, sign a short agreement with someone, and then replenish the goods. That is short selling. However, in Hong Kong, the law does not allow you to do this. Unless you meet some special conditions, okay? So what are the conditions? Let's look at what the regulation says. A person shall not sell securities at or through a recognized stock market unless at the time he sells them, he or his principal has, or he believes he or his principal has, a presently exercisable and unconditional right to vest the securities in the buyer. I know every word, but don't know what it means? It means that before short selling securities, you must first own or ensure that you can own these securities. Whether through borrowing or other means, in any case, you need to ensure that the buyer can receive the securities after signing the contract with you. This kind of short selling is called covered short selling. The SFC allows covered short selling, but does not allow naked short selling. If you cannot confirm the ownership of the securities before short selling, it is naked short selling. Naked short selling is an offense. So remember, under normal circumstances, you cannot short sell stocks on the SEHK, the Stock Exchange of Hong Kong, okay? What about futures? Futures are allowed, options are allowed, stock and securities are not allowed. You cannot short sell unless it is covered short selling. So, who and under what circumstances can short sell on the SEHK, Stock Exchange of Hong Kong? Firstly, those who are dealing in odd lots. Dealing in odd lots refers to the trading of a number of shares that are less than the normal unit of trading for that particular stock, which is usually a round lot of 100 shares. For example, if you only have 35 shares and want to sell them, you need to conduct an odd lot transaction. It's important to note that those who engage in odd lot trading are allowed to short sell. Secondly, those who sell options of the related securities. This means that even though you do not currently hold the stock, you have options, warrants, or convertible bonds of the stock that can be immediately converted into the stock. In other words, after you short sell, if necessary, you can immediately use your options, warrants, or convertible bonds to convert into the stock. In this case, you are allowed to short sell. Thirdly, those who have a presently exercisable and unconditional right in relation to the related securities, which is known as covered short selling. What constitutes covered short selling? It is when the seller has sufficient evidence, usually in the form of documentary assurance, to prove that they have these securities. As a seller, what evidence or documents can prove that you actually own a certain security? 1. SBL, Securities Borrowing and Lending Agreement, that is, borrowing securities through securities lending to short sell. For example, I don't have HSBC shares in my hand now, but I think the price of HSBC shares is too high. Then I ask the intermediary, or other people, to borrow some shares. After borrowing the shares, I sell them. Then after a while, I buy it back at a lower price and return it to the person who lent me the shares. 2. Can be used to transfer or acquire ownership of related securities, for example, holding convertible bonds or warrants. These tools can be converted into a certain number of securities. 3. Own options related to securities. For example, if you have the option to buy a specific stock, you can exercise it when the option expires to exchange for the stock. 4. Rights or warrants to subscribe for and receive the security. Think about it, you are in McDonald's, and you get a coupon. Before it expires, you can buy a McChicken meal for a discounted price of $25 with this coupon. Subscription rights are actually the same. If you hold the right, this security gives you the right to buy stocks at a specific price within a specific period. In short, as long as the seller can provide solid documents to guarantee that they can unconditionally obtain the related securities when selling the securities, this is a covered short sale. When short selling on the SEHK, Stock Exchange of Hong Kong, special restrictions must be followed. First, when short selling, only securities approved by the SEHK can be selected. The SEHK stipulates that only a small number of specific stocks can be short sold. Generally speaking, only large blue chips and large companies can be short sold. Small stocks and small listed companies cannot be short sold. Okay? Second, before short selling, a stock borrowing arrangement must be established with the person who owns these stocks, such as other brokers, investors, etc., that is, a SBL, Securities Borrowing and Lending Agreement. For example, if broker A wants to short sell 1,000 shares of Café de Coral, but he does not have Café de Coral shares now, then he needs to sign a Café de Coral SBL agreement with broker B who owns Café de Coral shares. In short, documents must be provided to ensure that this is a covered short sale. Third, the short selling price cannot be lower than the selling price. Remember, it cannot be lower than the selling price. For example, the selling price is now $80 and the buying price is $79. So if you want to sell now, you have to sell at the price of $80. In other words, if you short sell, you cannot go below the level of $80. Okay? It cannot be less than $80, it can be $81, it can be $80, but it cannot be less than $80. Finally, when placing a trading instruction on the stock exchange, it must be marked that this transaction is a short sale. It must be clearly stated that this is a short sale transaction. What are the regulations related to short selling? Everyone should know about the following. The provisions in SS 170 to 172, SFO. Securities and futures, short selling and securities borrowing and lending, miscellaneous, rules. The guidance note on short selling reporting and stock lending record keeping requirements. Guidance note on short position reporting. Short selling regulations in the 11th schedule, rules of the exchange. Securities and futures, short position reporting, rules. When we talked about short selling earlier, we briefly introduced the concept of SBL, securities borrowing and lending. So can you now answer, what is SBL? If you can't answer, it's okay, let's review it together. SBL means borrowing from the current holder of the security, from the borrower's perspective. So remember, since what is borrowed are securities, what is returned are naturally securities, plus some interest. Remember this mnemonic: borrow securities, return securities. This is the meaning of SBL. Speaking of money, do you remember how much is the stamp duty on stocks? It's 0.13% of the transaction. Some people might say, small amount, it's trivial. But when the transaction amount is large, it's not a small sum. But did you know that SBL can be exempt from stamp duty? Why can it be exempt from stamp duty? Because the ownership has not changed, it is purely a lending arrangement and will eventually return to the original owner, so there is no need to pay stamp duty. Do you understand? What are the benefits of SBL? After borrowing the securities, you can sell them. As we introduced earlier, you need to ensure that you have securities in hand to short sell. Usually, these securities are borrowed by the seller. So covered short selling, in simple terms, is borrow securities first, then sell them, and then buy them back to return. You can sell, and others can buy. Under this circumstance, a large amount of securities held by banks, fund custodians, and other custodial institutions, which were originally unable to circulate, can now flow into the market, and the liquidity will be higher. Also, have you ever thought about, some elderly people may hold blue-chip stocks and plan to hold them for a long time without selling. At this time, there is a gambler who wants to borrow the elderly stocks to short sell, and he will also give some interest to the elderly. The elderly lend it to him, not only can earn the original dividend, but also earn more interest from securities lending. So the elderly have some extra income, and it will not affect the shares they currently hold. Do you understand? Have you ever thought about what responsibilities you would have when you borrow someone's stocks? If you are the borrower of securities, listen carefully. You must provide collateral, and the value of the collateral must be at least 100% equal to the value of the securities you borrowed. So if you want to use it for short selling, you have to leave an extra 5%, that is, 105% of the collateral, okay? You might wonder, how is this value calculated? Actually, it is calculated daily based on the closing price of the previous trading day to determine how much margin or collateral needs to be placed. what is short position reporting? Another concept related to short selling is short position reporting. So, what is short position reporting? Simply put, a short position is a bearish view. If I sell the shares I borrowed through short selling, this is holding a short position. If the net short position in specified shares, such as Hang Seng Index constituents, Hang Seng China Enterprises Index constituents, etc., held by a SEHK, Stock Exchange of Hong Kong participant, i.e., the total amount of short selling 1. Exceeds 30 million, or 2. Represents more than 0.02% of the issued shares, then it must be reported to the SFC, Securities and Futures Commission, within 2 working days. Do you understand? After talking so much about short selling and borrowing stocks, let's talk about what services the HKSCC, Hong Kong Securities Clearing Company Limited provides, okay? What is the HKSCC? It's a clearinghouse. What does a clearinghouse do? The most important thing, of course, is the clearing and settlement services for securities. Besides, it also has several services. You don't need to know too much detail, just knowing the name is enough, because the exam will not test the specific content. One is called depository services. One is called common nominee services. One is called electronic securities application. One is called tendering services. Just knowing this is enough, okay? Let's test you. What system does the HKSCC, Hong Kong Securities Clearing Company Limited use for settlement? Central Clearing and Settlement System, CASS. So where is this CASS? It's in the HKSCC. So who can use this CASS? The participants of the CASS, including the following participants, such as direct clearing participants, general clearing participants, also known as CASS clearing participants, clearing agency participants, custodian participants, stock lender participants, stock pledgee participants, investor participants. These people can use the CASS system, okay? Just remember the name. There is a very special example that you may not know. Individuals, including you and me, any individual can open an investor account in the CASS and become an investor participant. So in the future, when the broker helps us to buy and sell, we just need to instruct the broker to transfer the stock of this transaction to the account of the CASS. It can be done, okay? This avoids the problem of intermediary default. The stock and money positions of a CASS, Central Clearing and Settlement System clearing participant, are calculated based on continuous net settlement. Not sure what net settlement is? That's normal, don't worry. Before explaining what net settlement is, I have to ask you a question. Do you still remember what novation is? This concept is related to clearing and settlement, so let's review it first. If you want to settle securities or funds, the buyer and seller have to participate in a settlement process after trading on the SEHK, Stock Exchange of Hong Kong. This is also the process of clearing and settlement in the CASS. Usually when buying and selling stocks, you don't know who your counterpart is. For example, I bought 3,000 HSBC shares, and there may be several sellers, but I don't know any of them. But that's not important. After buying, I just need to pay the HKSCC, Hong Kong Securities Clearing Company Limited. Then the HKSCC will help me chase the seller to get HSBC shares. Do you understand? Since the buyer and seller do not know each other, the HKSCC automatically becomes our counterpart in this stock transaction. I only need to clear and settle with the HKSCC, and I don't need to know who sold the stock to me or who bought it. So if I bought stocks and the other party can't deliver stocks to the HKSCC, do I have a loss? Regardless of whether the other party has delivered the stock to the HKSCC, the HKSCC must deliver the stock to me. In this case, I don't need to worry about the other party not taking responsibility and then causing our loss due to default. This loss will be borne by the HKSCC, and I will definitely receive the stock. Do you understand? This process of avoiding risk is called novation, okay? In this situation, the buyer and seller actually clear with the HKSCC separately. What is continuous net settlement? Continuous net settlement is a method of settlement. What does it mean? On the same day, the buy and sell orders of the same stock will offset each other, resulting in a single net stock position and a net amount of settlement cash. Exchange participants only need to settle this net amount of the stock and the net amount of settlement cash with the clearinghouse. For example, Kaohsiung Securities bought 3,000 shares of Vitasoy on the SEHK Stock Exchange of Hong Kong today and also sold 2,500 shares of Vitasoy. Because there may be many customers of Kaohsiung Securities buying Vitasoy and many customers selling Vitasoy. No matter, what's the most important? First, today's purchase of 3,000 shares minus today's sale of 2,500 shares. So, today's net stock amount is a net purchase of 500 shares of Vitasoy. The second thing, what price were these 3,000 shares bought at, and what price were those 2,500 shares sold at? See if the total value of the purchase is more, or the total value of the sale is more, and get a difference. This is the net amount of settlement cash. We only calculate the net amount, is it all right? So how does the Central Clearing and Settlement System, CCASS, work? It's actually quite simple. 1. On each trading day, i.e. T. Day, trading data is automatically relayed from the SEHK trading system, OTC, the Orion trading platform to the CCASS, Central Clearing and Settlement System, informing it who the buyer is, who the seller is, and how to track them. 2. At 5 p.m. on the same day, CCASS provides a provisional clearing statement to the clearing participants, showing the stock positions traded on the SEHK Stock Exchange of Hong Kong that day, and the amount of funds. At 8 p.m., CCASS provides another provisional clearing statement to the clearing participants, showing the options trades made on the SEHK that day. Brokers can cross-check with their internal records to see how much stock they need to deliver, how much money they need to deliver, and if there are any discrepancies. If there are any issues, they can communicate with the HKSCC, Hong Kong Securities Clearing Company Limited. If there are no problems, there is nothing they need to do. 3. On T+1 day, i.e., the second day of the trading day, after 2 p.m., CCASS will give the final clearing statement to the clearing participants as an instruction for settlement. For example, this final clearing statement might say, Kaohsiung Securities, you need to deliver 500 shares of Wyeth milk. In addition, you will receive a certain amount of money, which you will receive tomorrow. Please deliver the shares you need to deliver to CCASS today. This final clearing statement is meant to achieve this effect, all right? What should a clearing participant do after receiving the clearing statement? We've talked before that settlement takes place on T+2, so they need to put the shares ready for settlement in CCASS, Central Clearing and Settlement System on T+1, which is the day after the trading day. Remember, it can't be later than T+2. If the HKSCC, Hong Kong Securities Clearing Company Limited, can't get the shares at the time of settlement before the end of T+2, which is 2 days after the trading day, the HKSCC will force the clearing participant to make a mandatory cover on T+3 and buy the required shares at market price, okay? They must ensure that they return these shares to the clearinghouse. Clearing participants with insufficient positions not only have to bear the cost of buying shares, but also need to pay a fine. So how to settle? Remember, the method of settlement is delivery versus payment, that is, one hand delivers the goods and the other hand pays. So who delivers the goods and who pays? It's the clearing participant and the clearinghouse delivering goods and money hand in hand. To achieve delivery versus payment, these clearing participants must first open an account in a bank recognized by the HKSCC. After opening an account, the HKSCC can settle shares and funds in the form of automatic electronic debit and credit entries on the settlement day, including making deposits or debits. Do you understand? So if someone violates the rules of the exchange, are they breaking the law? The answer is very clear, remember. The rules of the exchange are not laws, so there are no criminal consequences. So will they go to jail? Of course not. But what are the penalties? Disciplinary actions can be taken, including warning letters, fines, suspension of exchange participantship, etc. Okay? As we have introduced before, we can not only buy and sell securities on the SEHK, Stock Exchange of Hong Kong, but also trade options on stocks. The options on stocks traded on the SEHK are called traded options. They are issued based on the actively traded stocks listed on the SEHK and can be divided into two types. One is called call options, and the other is called put options. So what exactly is a call option? And what is a put option? Let's talk about call options first. The buyer, i.e., the person who buys the option, also known as the option holder, has the right, but not the obligation, to buy the stock at a specified price, i.e., the exercise price, on or before a specified date. What about put options? The buyer also has the right, but not the obligation, to sell the stock at the exercise price on or before a specified date. Both are rights. One is the right to buy the stock, and the other is the right to sell the stock. Do you understand? The option buyer, i.e., the person who buys the option, has the right to exercise the option, and also has the right not to exercise the option. What does that mean? It's like you bought a mooncake voucher. Before the deadline, you can choose whether or not to use this voucher to redeem a box of mooncakes. As a buyer, you have no responsibility or obligation to exercise this right. It's up to you. Of course, there's no such thing as a free lunch. The buyer has to pay for this right, and this money is called the premium. The option seller, i.e., the person who sells the option, has no freedom and no choice. Moreover, they have a responsibility to follow the wishes of the option buyer. If the buyer exercises the right, the seller must buy or sell the stock at a specific price. It's like a mooncake shop. If a customer comes to redeem a box of mooncakes with a voucher, as long as the voucher is not expired, you have to fulfill your responsibility to deliver the goods. So why would the seller do such hard work, such thankless work? As I mentioned earlier, it's because the option seller receives the premium, all right? So, if you look at this table, you can understand the obligations of both parties in a call option. The buyer of a call option has the right to buy the asset at a specified price. It's not an obligation. They have the right to choose whether or not to exercise this right. As for the seller of the option, they have the obligation to sell the asset to the buyer at a specific price when the buyer exercises the option, all right? Next, let's talk about the rights and obligations of parties in a put option. The buyer of a put option has the right to sell assets at a specified price, which is not an obligation, okay? They have the right to choose whether to use this right. But the seller of a put option has the obligation to buy assets at a specified price when the buyer exercises the option. As we just mentioned, the option holder can exercise the right to buy or sell at any time before a specified date. However, some people might ask, so, can all options be like this? The answer is no. Options that can be exercised at any time before a specified date are called American-style options, while European-style options can only be exercised on the expiry date. So, can anyone answer me, which type do the options on stocks traded in Hong Kong belong to? American-style options. That means they can be exercised at any time before the expiration date. All right? So what's the difference between futures and options? Futures are obligatory to buy and sell. Both buyers and sellers have the obligation to execute the contract. After the contract is set, no matter how the market price changes, they must buy, sell, and settle according to the price stipulated in the contract. However, in an option contract, the buyer of the option, i.e. the option holder, has the right to choose whether or not to execute, and also has the right not to execute. In other words, the buyer of the option has flexibility in whether or not to complete the contract, but the seller of the option must act according to the buyer's wishes. To increase market liquidity, the SEHK, Stock Exchange of Hong Kong, has implemented a market maker mechanism in the traded options market. What does a market maker do? Market makers need to be both buyers and sellers for a long time, constantly publishing option buy and sell quotes. As long as someone wants to buy or sell stocks, the market maker can become the counterparty, making it possible for the market to trade at any time. Who can be a market maker? Options trading exchange participants can apply to the SEC to become a market maker for a particular option class. Who are the participants in the options exchange participants? Options exchange participants are mainly divided into two categories. One is called the options trading exchange participant, and the other is called the options broker exchange participant. What is the difference between these two categories of participants? Let's first look at whether they have system access rights. What is system access rights? That is, the right to directly connect to the SEHK, Stock Exchange of Hong Kong trading system. Let me ask you, which system is used for trading stock options? Correct, it's the CATS, the Hong Kong Futures Automated Trading System. Options trading exchange participants have system access rights and can directly input trading instructions and quotes for automatic matching through the CATS. As for options broker exchange participants, they have no system access rights, and cannot use the options exchange's computer, okay? So, who can the options exchange participants handle trades for? Options trading exchange participants can handle trades for their own company, their company's clients, options brokerage exchange participants, and clients of options broker exchange participants, okay? As for options broker exchange participants, since they cannot use the computer, they can only act as intermediaries. That is, they can only help their own company, or their company's clients, conduct stock options trading and transactions through the previously mentioned options trading exchange participants, all right? Note that whether it is an options trading exchange participant or an options broker exchange participant, they need to be licensed or registered by the SFC and registered with the SEC before they can engage in traded options business. So let's summarize, how is the process of stock options trading done? First, options trading exchange participants input trading instructions and quotes through the CATS electronic trading system for automatic matching. After the matching transaction, the transaction will be directly sent to the CCASS, Derivatives Clearing and Settlement System for processing. If you still remember, we said that stock options are monsters, so we need to find someone to deal with them specifically, so it is specifically handled by the SEHK Options Clearinghouse Limited. Do you know, not everyone can become a participant in the SEHK Options Clearinghouse Limited, i.e. SEHK participant? Only an options trading exchange participant can become a SEHK participant. And there are two types of SEHK participants. One is called general clearing participants, and the other is called direct clearing participants. Both can do clearing, so what's the difference? The difference lies in who can do the clearing for. General clearing participants can not only clear options trading for their own company and their own company's customers, but also for direct clearing participants and non-clearing participants. So what about direct clearing participants? They can only clear for their own company and their own company's clients. In simple terms, general clearing participants can clear for everyone, but direct clearing participants can only clear for themselves. So how is the margin for options calculated? The margin for trading or buying and selling these options will vary with the prevailing market prices of the stock. That is, because the stock price changes, the price of the stock options will also change. Therefore, the corresponding margin will change every day. Because of this, we need to recalculate the margin based on the closing price of the day. So when is the margin recalculated? After the end of each trading session, the mark-to-market margin will be recalculated. In addition, one of the great powers of the options clearinghouse is that if the market fluctuates too much, it can require participants to make up the margin within an hour, which is called intraday margin call. Generally speaking, if the margin is less than 50% of the required level, this intraday margin call will be automatically triggered. Okay? So how is this margin calculated? It is calculated based on the prevailing market price. Let's take a look at how to collect margin/premiums/collateral. Before buying and selling, the options exchange participant must receive the client's margin/collateral/premium in order to carry out the buying and selling and trading for the client. If the client cannot provide sufficient margin and collateral, then the client is considered to be in default, okay? After the end of each trading session, the SEHK, the SEHK Options Clearinghouse Limited, will recalculate the mark-to-market margin to confirm how much margin to collect for the stock. On the next day, i.e., T+1 day, the SEHK will automatically debit the clearing participant's bank account. If there is not enough money in the bank account, the clearing participant will be asked to pay more money. All payments due must be confirmed before 9:15 a.m. If they cannot be paid, then the clearing participant is in default. If an options clearing participant, i.e., a broker, cannot pay the margin, regardless of the reason, whether the client is out of money or the broker has a problem and cannot pay the margin, what should be done? The SEHK, the SEHK Options Clearinghouse Limited, has to take action to chase it. But if it can't be chased, what can it do? First of all, regardless of the participant's intention, if he cannot be found or he cannot pay the margin, he should take the initiative to close his position. For example, if this participant is buying a rise, he should immediately sell it back for him, because he is buying a rise and losing money now. If he doesn't have enough margin, help him close the position to stop the loss. There are other choices. The clearinghouse can also help him to roll over, transfer his position to the next month's contract, and make corresponding adjustments. Or, sell the collateral. Sell the pawn of this clearinghouse participant, that is, the items used for margin or collateral. In short, it is necessary to help them fulfill their responsibility to chase the margin. If there is still not enough money, the SEHK can also use its own reserve fund or insurance to cope with this emergency situation. After talking about the securities and options related to the SEHK, Stock Exchange of Hong Kong, let's now talk about the HKFE, the Hong Kong Futures Exchange. But before introducing the HKFE, let's first review the derivatives market in Hong Kong. Let's test your memory. Do you still remember how the derivatives market in Hong Kong is structured? The derivatives market in Hong Kong includes both on-exchange and over-the-counter trading. On-exchange trading mainly takes place on the HKFE, which is of course managed by the HKFE. So let me ask you, who is the parent company of the HKFE? The answer is HKEX, Hong Kong Exchanges and Clearing Limited. Remember, HKEX wholly owns the HKFE. How about the over-the-counter market? It's decentralized, with the trading parties negotiating on their own. Over-the-counter derivatives include interest rate swaps, forward foreign exchange contracts, interest rate agreements, forward rate agreements, foreign exchange swaps, currency swaps, etc. We have introduced these in the rules for reporting and clearing of over-the-counter derivatives before. The HKFE has many different types of derivatives trading, including what? Derivatives of stock indices mainly include Hang Seng Index futures and options, Mini Hang Seng Index futures and options, Hang Seng China Enterprises Index futures and options, Mini Hang Seng China Enterprises Index futures, Dividend futures, Hang Seng Index Volatility Index futures, etc. Stock derivatives include stock futures and stock options. In addition, there are some exchange rate, interest rate products, and gold. The trading of stock options, as we mentioned before, is handled by the SEHK, Stock Exchange of Hong Kong. The rest of the derivatives are handled by the HKFE, the Hong Kong Futures Exchange. Which laws and regulations apply to the HKFE, Hong Kong Futures Exchange and the Clearinghouse? The SFO, Securities and Futures Ordinance. HKFE rules, the rules, regulations, and procedures of the Futures Exchange. HKCC rules, rules and procedures of HKCC. Who can be a participant in the Futures Exchange? Do you remember what we talked about before? What do you need if you want to trade futures contracts? That's right, you need a Type 2 license issued by the SFC, Securities and Futures Commission. Here comes the question. If you get this Type 2 license, do you automatically become an HKFE, Hong Kong Futures Exchange participant? Not really. In fact, getting a Type 2 license is just the first step. You also need to obtain trading rights and register as an HKFE participant. Only after becoming a participant can you participate in trading. So, what are the categories of HKFE, Hong Kong Futures Exchange participants? There are 4 types of HKFE participants, including traders, brokers, futures commission merchants, and merchant traders. After hearing this, you might think,
There are so many types of futures participants, I'm afraid I won't remember.
Don't worry, I'll teach you how to remember. Most importantly, the classification is based on identity. First, traders and brokers are natural persons, real people. Second, futures commission merchants and merchant traders are companies. Traders can only trade for themselves, only for their own investment. Brokers trade for themselves and for other HKFE participants, i.e., traders, futures dealers, and merchant traders. Futures commission merchants are the most powerful, they can trade for everyone. Another one is the merchant, it is like a trader, but participates in the company's identity. These are called merchant traders. Who can become HKCC participants? Similarly, only participants of the HKFE, Hong Kong Futures Exchange can become HKCC, the HKFE Clearing Corporation Limited participants. What types of futures clearing participants are there? There are 2 types, general clearing participants and clearing participants. Who can general clearing participants clear for? They can clear for everyone, all HKFE participants. Who can clearing participants clear for? They can clear for themselves and other clearing participants. So how to conduct futures trading? Each HKFE, Hong Kong Futures Exchange participant must register with the HKFE and, after approval by the HKEX, Hong Kong Exchanges and Clearing Limited, can trade through the CATS, Hong Kong Futures Automated Trading System. Like stock options, HKFE participants must receive margin from customers before trading. So, how much margin should be collected? The HKFE, Hong Kong Futures Exchange clearly stipulates, for different products, set the minimum basic margin requirement level for opening new futures contracts, that is, how much the minimum margin is stipulated. However, HKFE participants can decide how much margin to collect from the client based on the situation. However, it should be noted that it must not be lower than the prescribed minimum level. If the client cannot pay the basic margin or margin collateral, can the HKFE participant trade for him? Remember, the answer is no. If the HKFE participant has not received the basic margin or margin collateral provided by the client, they cannot trade for the client. Because the fund margin is a credit margin, if even the basic margin cannot be paid, it is difficult to believe that the contract can be successfully performed, right? If a client doesn't have enough margin, they generally can't establish a position. Are there any exceptions? Actually, there are. But not everyone is eligible, only certain existing clients are. Imagine, you go to a tea restaurant to eat all the time, and you always pay enough money. The boss might say to you, "You forgot to bring money this time? No problem, give it to me tomorrow." Futures trading is the same. If the regular client has always been able to pay the deposit, has a good financial situation, and also declares that they can pay in full immediately. These well-credited regular client, futures exchange participants can trade for him, but they may not be able to help much, only a little. Why is that? Because there are some restrictions. So what are the restrictions? If the regular client establish a new position on the trading day, then the broker, HKFE participant, must issue a notice to pay the margin to the client within the trading session of the trading day, that is, the T session, and the client must pay the deposit within the T session. If the regular client establishes a new position after the close of the trading day, that is, the T+1 period, then they must pay the margin within the next trading day. However, even if it is a regular client, if their margin is overdue, and they still haven't paid after the deadline, they can't establish a new position for him. Do you understand? In addition to the basic margin, there is also a maintenance margin requirement. So what is the maintenance margin requirement? When a client wants to continue holding a futures contract, they need to maintain the required minimum margin level, i.e., the client's account needs to maintain a certain balance. If one day, the client's money is insufficient in his/her account, and the balance falls below the maintenance margin level, what will happen? The client will receive a notification requiring them to add margin. The client then needs to deposit money into the account as soon as possible to replenish the margin and restore it to the required level. How is the futures margin calculated? It can be based on a gross basis or a net basis, depending on the type of account. Don't know what that means? No worries, let me explain. Let's take an example. Today I bought 3 contracts, 2 are long positions and 1 is a short position, with a margin of 100 each. The gross basis means that the margin for all contracts, whether long or short, is calculated separately and then accumulated. So, in this example, the total margin is 300. But the net margin only calculates the difference, so the total net margin is 200. Like options, the daily margin of futures contracts is calculated based on the market price. At the end of the T period, all open contracts are treated as if they have been closed, and new contracts are established at the closing price. For the contracts treated as closed, whether they are profitable or losing, they are directly deposited or deducted from the account of the futures clearing participant. If the price fluctuates too much, the futures clearinghouse requires participants to make a margin call on the same day. Remember, there are 2 ways of settlement in futures trading in Hong Kong. First, cash-settled contracts. The name makes it very clear. It is settled in cash. And what about physical delivery contracts? Simply put, the seller of the contract delivers financial products, commodities, or currency, and the buyer pays in cash. In addition to the rules of the HKEX, Hong Kong Exchanges and Clearing Limited and its subsidiaries, the SFC, Securities and Futures Commission has also established rules related to trading. Among them, the most important are the trading position limits and reporting requirements, also known as the Securities and Futures, Contracts Limits and Reportable Positions, Rules, or the Contract Limits Rules, for short. Remember, violating the holding or reporting requirements is an offense, and if convicted, you can be fined or imprisoned. Okay, let's look at what is meant by trading position limits. The trading position limit, that is, the number of futures contracts or stock options that anyone holds on the exchange, cannot exceed a specified upper limit. So what are the trading position limits? We have a table for everyone to look at. You can look at it yourself and see how many position limits correspond to different products. The Contract Limits Rules also stipulate that if a contract holder reaches a certain position limit, they must make a report. As for how much the position limit is, you can look at this table again. So how do you report? When your position reaches the reporting limit, you need to notify the exchange within the next business day. If you continue to maintain a position above this value, you need to notify on each subsequent business day. Have you ever been attracted by fancy packaging when shopping, leading you to make a purchase? Even if you didn't plan to buy it, the product description was so positive that you couldn't resist. I think many people have had this experience. The same goes for investment products, especially listed structured products, which can be very complex and carry different risks. If the promotional materials are false and you mistakenly buy in, your bank deposit could be reduced to zero in no time. To protect investors' wallets and prevent blind purchases, the SFC, Securities and Futures Commission, has developed the Guidelines on Marketing Materials for Listed Structured Products, referred to as Structured Product Guidelines, to regulate the market behavior of promoting listed structured products. These guidelines do not have a force of law, but if intermediaries fail to comply, it will reflect adversely on the fitness and properness of licensed or registered persons. What are the regulations in the Structured Products Guidelines? First and foremost, it is crucial to ensure that the marketing materials for listed structured products are truthful and fair. That is, you can't say you're selling gold when it's just gold foil, as that would be misleading or deceptive. Moreover, there should be appropriate risk warnings in the materials, reminding everyone that while there is potential for profit, there is also a risk of loss. Therefore, the content should detail the investment items and the risks involved in the product itself. Also, a balanced view should be provided for these products. Any potential gains and losses should be communicated to the investor. Lastly, all information, including risks, returns, investment items, etc., should be easy to read and prominent. Are you preparing for HKSI, MPFE, IIQE, EAQE, or SQE examinations? Look no further. At 2C Exam, we have everything you need to succeed. Our comprehensive suite of products and services includes premium online and offline question banks, personalized one-on-one tutorial sessions, tailored group classes, and private consultation sessions. Need assistance with licensing or examination inquiries? Don't hesitate to get in touch with our knowledgeable team. We're always here to help. We're open Monday to Friday, from 9 a.m. to 12 p.m. and 1 p.m. to 6 p.m. You can reach us by phone at 211-09644 or send us a message on WhatsApp at 934-72064. Need to send us a fax? Our fax number is 211-19644. Prefer email? Drop us a line at info@2cexam.com. And don't forget to connect with us on WeChat, HK2C Exam. Choose 2C Exam, your path to exam success. Reach out to us today and let us help you achieve your goals.